Hello and welcome to Mining Beacon's latest webinar, this one being a focus on copper. I'm Chris Hind, Chief Commentator for Mining Beacon, which is the news website owned by Beacon Events. That's the company that organises the Mines and Money series of conferences and also IMARC in Australia. First, a few housekeeping comments. The webinar is scheduled to run for 45 minutes and as far as I'm aware there's no fire drill expected, so us here in London shouldn't have to suddenly abandon things unless it's serious. Via email, all registrants will receive a copy of the recording of this webinar, and panelists, of course, are available to have links to the video they can pass on. You can ask questions at any time by using the questions tab in the GoToWebinar panel on your screen. And finally, if you experience any trouble with sound, we recommend that you exit the webinar and start again by logging back in. Now to the red metal. It's clear from talking to investors who attend our Mines and Money events that there's a sharply greater interest in copper in the last year in particular. Investors are particularly bullish, as far as we can make out, on the long-term fundamentals of copper. This is boosted especially by the growth in electric vehicles and batteries. On the supply side, as we're going to hear, there's a continuing decline in ore grades, coupled with a historical underinvestment in the supply pipeline. On top of this, many copper mines are in politically risky jurisdictions, as no doubt our panelists will discuss. Taking these factors into account, many long-term investors have recognized increasing opportunities in the copper market. The industry itself seems to have responded, with operators of primary copper mines increasing their capital expenditure by 17% last year to $24.3 billion, and copper exploration budgets also increased last year, up 22% year over year to $2.1 billion. Both of these estimates come from S&P Global Market Intelligence. To discuss some of these issues, we're joined by four panelists today. First, the CEO of North Shore Capital, Jeremy Atkinson. Jeremy has spent the past 12 years providing commercial and financial modelling services on mining projects in Australia, Africa, the Americas and Europe. Second, we have the Senior Copper Analyst at S&P Global, Keeble, formerly with Wood Mackenzie and Fast Markets. Keeble is the copper analyst at S&P Global Mining Intelligence and actually was a former colleague of mine. The sister companies of that group include Standard & Poor's Rating Agency and Platts. We've also got the principal of Housekeeping Company, Christopher Eccleston, and I owe Christopher an apology. We've got his name spelt wrong on that slide. It's E-C-C-L-E, not E-L. A mining strategist, Christopher is a native of Melbourne and was the founder of the investment advisory company Housekeeping in New York 16 years ago. He's now based in London. And finally, we've got the president and CEO of Foran Mining Corporation, Patrick Suarez. A geologist, Patrick was appointed 9 years ago to the top job at Foran Mining, and he was previously CEO of Brett Resources. The sharp-eyed amongst you will notice I've missed someone. The fifth panelist, CEO of Xanadu Mines, Dr. Andrew Stewart, has unfortunately been caught up in the chaos at Hong Kong airport in the last couple of days and is on a rescheduled flight and so unable to join us. Let's start off, if we may, by discussing the fundamentals. This is always a pretty good place to start. That's the supply and demand of copper and their impact on the metal price. Keeble, at the sharp end, you're the S&P Global Market Intelligence copper analyst. What does the metal supply and demand picture look like, and how is this likely to develop in the future, and why?
Hi, Chris. Sorry about that. I had a bit of a sound issue there. Thanks for the opportunity to be on the panel. I think it's a very interesting time to be taking a hard look at copper's prospects, especially given price volatility so far this year. I'm going to spend a bit of time, so forgive me, just explaining my view. So make sure you interrupt me if I'm going on for too long. I think any analysis of copper's prospects this year has to be split into two distinct product markets, namely refined copper, as traded on the exchanges such as the LME, and copper concs, copper concentrates, which is the main product sold by mining companies. So beginning with refined copper, I think we'll end the year with a slight surplus, which is different to what we thought at the end of last year, when we thought we would end this year in a deficit. So there's been a slight shift in where we think the market balance is going. I've trimmed back my demand growth prospects as this year has progressed, mainly on the back of an unexpected intensification of the US-China trade dispute. The trade dispute is important because a large amount of Chinese exports to the US are copper intensive. So there's the potential for some demand destruction. I've considered mitigating factors also, like China's economic stimulus measures, the US Fed's rate cut. These only amount to a steadying of the ship. And I don't think they alone can re-energize growth rates this year. On the other side of the coin, refined supply has been a mixed bag. Over 2 million tons of primary Chinese smelting capacity is coming online between 2018 and 2020. And this has helped China feed its own demand. There have also been significant smelter disruptions, with Vedanta's Tuticorin offline since May last year, and Codelco's smelter refurbishments delayed. But in general, I think smelter disruptions are offsetting a large part of the slowdown. So we're only seeing a very narrow surplus this year. I don't think it's going to be it's essentially a balanced market, but with a slight surplus. I contrast the surplus cathode market outlook with concentrate markets, which are widely accepted, I think, to be in deficit. So we only need to look at how low the fees charged by smelters to miners have dropped. Spot treatment and refining charges, spot treatment charges are approaching $50 a ton. CIF Shanghai, nearly half of where they were at the end of last year. And I think this is more of a function of China's scrap import restrictions rather than mine disruptions, which are actually low compared to previous years. And I did an analysis actually just yesterday, which showed that average margins this year at primary copper mines won't fall as much as they would have given the price, where the copper price is at the moment, largely due to the offsetting factor of the lower TCRCs this year, but concentrate markets heavily in deficit.
Right. And is this going to continue beyond this year? That sort of scenario?
It's an interesting one. I mean, I think the smelter expansions in China, you've got smelters coming online throughout the end of this year, which will ramp up into next year. And I think that will feed a lot of the extra need for concentrate. And China is much shorter concentrate than they are cathode. So I think the concentrate story will continue much longer than this year. Cathode story, given that it's become the price has become quite strongly correlated with key milestones in the US-China trade dispute, I think we're looking at quite a volatile market all the way up to the election next year, the US election. And I think another key part is also the fact that the Chinese currency has now moved against the US dollar above the 7 level, so it's depreciated to above 7 for the first time in over 10 years. And I think that's sort of a really bad sign, because the arbitrage, for Chinese buyers to buy LME material compared to the cost competitiveness of SHFE material or Shanghai Futures Exchange material is heavily negative. It's heavily unprofitable for them to buy the LME material and import it in. And a weakening currency, potentially to whoever, who knows what the next red line is for the currency, the Chinese currency. It's going to heavily keep the arbitrage in negative territory. So,
right. Of course, over and above all this, and I'm sure other people might allude to it, is a certain Mr. Donald Trump who's bound to play chaos in one way or another with these things. Christopher, looking at the slightly longer term, Keeble's talked about what's happening this year and the next couple of years and the fundamentals. How significant is copper usage in clean energy and electric vehicle applications? I mean, clearly it has a pretty significant role, but how will this change copper demand patterns going forward, do you think?
I suspect that people have got ahead of themselves on this front, and that they may indeed be heading for a bit of a wake-up moment, because obviously the West has not come to the party on EVs in the way that it was supposed to do. And even in the very short term, we see European economy is slowing down, wobbles in the US, that the US is maybe slowing down, and then the whole of the emerging markets appear to be slowing down. So they're not going to be doing anything. I think the real shock is going to be if China's uptake of EVs, which has been almost sort of forced upon the Chinese public, actually, you don't have to buy an EV if you're Chinese. If you decide that you're not going to buy anything, then the demand in China could slow down for these things, and that's going to be a real shock to people who've been arguing, but not just in the copper space, but in the lithium and the cobalt and all these other battery metals, that the only way is up with EVs, and I'd have my doubts. On another front, coming back to the comments that we just heard, there's an old expression about lies, damn lies, and statistics. And
yes.
for a long time in China, the public have, the observers from outside have regarded Chinese statistics on many things as being bogus. The one that they haven't questioned very much is the GDP numbers. And so when China's booming, GDP is up 7% in a year. When China's not booming, it's up 6% in a year. And to me, that just doesn't ring true. The reports I'm hearing out of China on the broader scale, not just in specific industries and specific activities, is that there's a really big slowdown going on, really big slowdown, and the gloom and doom is quite phenomenal. And I wouldn't be surprised if the real growth in China is something like 1%. And who knows? Because as you know, in China, you're not allowed to come out and say that you think the growth is any less than the official number.
Yeah.
And
so the FT's been querying these numbers off and on for the last couple of years, hasn't it? I think.
And the worst thing is that if you're saying it's 6% every year, and then you're compounding that 6%, because that's what growth's all about, you can end up with an economy that's estimated to be so much bigger, but in fact you could be massively overshooting in how much bigger it actually is. And I think that part of the copper price malaise at the moment is the Chinese growth is just not, well, the malaise in a lot of things, whether it's also zinc and other things, is actually a reflective that China is not growing anything vaguely like the public numbers, and that China is in real slowdown mode. And no one within China is going to sort of ring that alarm bell, because they'll end up in a re-education camp.
Well, particularly if they're in Hong Kong, The other thing, I mean, not wishing to be too pessimistic at this stage, and we'll get on to the more bright things in a minute, but I don't know if it's true everywhere, but I'm reading quite a lot about millennials here in UK, particularly, aren't buying cars anymore. So
I think we're seeing that. I think we're seeing that, and that could be a real big shock to the system as well. In the US, a lot of the big auto manufacturers that people see as getting ready to switch over, but they haven't actually done all that much on the EV front, is because they're really making their money out of larger vehicles, and the Fords and the GMs would far prefer to be producing big trucks and SUVs than little sedans, and they're moving away from that market. So they're just not addressing the whole EV thing. And with oil prices where they are, there's not much of an impetus in economies where the direction is not from the top down, as we've seen in Europe, with people talking about, by 2030 we're going to have 80% uptake and whatever. 2030 is not that far away. And I have a car now that's 19 years old. If I were to buy a new car now that was, I would hope that it would last another 19 years. So, a lot of the supposition out there is that people get rid of the cars that they've got. And cars in many places, where, in particular, most notoriously Australia and California, last a very long time. And there's an assumption out there that people are going to throw away perfectly good cars to switch into EVs. And at least in the UK, there's and quite a lot of other places in Europe, the provision of charging points is just not there. And so people get very nervy about making that jump.
I know I'm building a new house to retire to, and the architect suggested we put a fast charging point in, but I think I'm the only one in the road that's going to have a charging point. So, perhaps we could turn, Patrick, wearing your copper exploration hat, what do you think of the significance of falling copper grades as we see widely reported in the copper industry? And do you think the metal can be extracted more cost effectively in the future?
Well, yeah, I'm just listening to our to Keeble and Christopher, and we in the exploration and industry have to be a little bit more positive. We have to wear our positive hats here. We are real believers in the long-term price of copper, and so these falling prices and lower grades we see in a warped sort of way, especially on the exploration front, to be good for copper prices in the long run, because there is a saying that the best thing for low commodity prices is low commodity prices. My understanding is that the industry average to produce a pound of copper now is $2.85 US a pound, with copper trading at around $2.60 a pound. That means the average producer is losing 25 cents a pound to produce a pound of copper. Well, they can't do that for very long without slowing down production and shutting mines. And so that's one reason that we're positive that this slowdown in copper is just a temporary, or the lower prices in copper are just a temporary step. The other thing is that mines are getting deeper. There's a lot of mature copper mines in the world, and most of them are deeper, whether they be open pits or underground. And so the actual cost to produce a ton or a pound of copper and a ton of metal is going up. So both of those things we see as being positives for our market.
So you don't think there's a way that you don't think the industry, there can be a step change to make it cheaper to mine in any way?
There is. There definitely is. I think that unfortunately our industry is still we haven't even moved to the 20th century, let alone, we're just getting out of the 19th. And the thing that you can go to a mine these days and still see extraction done almost exactly like it was 50 years ago or 60 years ago.
It's a huge,
I would say 100 years ago.
Yeah, it's a huge criticism of the whole industry, isn't it? I mean, as I said, I qualified a long time ago, and I can see very little that's changed in my career, and there's not been the step change. One thing, I don't know if anyone else has seen it or any of the listeners are aware of it, but the former chief economist at Rio Tinto, Dr. Philip Crowson, used to do a lot of long-term price and cost forecasts and rather than charting, and he did real prices and production numbers from copper, and he pretty well proved that when the copper price drops below 10% of the 90th percentile of operating costs, the price will bounce. And the last couple of years have been an exception to that, but he quite conclusively proved that it can't go below 10%. You can't drop below the 90th decile for long without metal prices coming back.
Right, and we have to be believers in that. But one of the things that I think, Chris, that is happening in our industry is, the biggest component of running a mine these days is the labor cost. It doesn't matter where you are, and automation is actually starting to catch on in our mining industry. It is a good way. So if you've got trucks that are running the same route, taking ore to a mill or to a processing plant, it makes sense to automate those. It's better both on the safety front. It's easier on equipment because you set up the trucks to run at the same speed, and so it improves both the safety record and the longevity of equipment. It gives you that opportunity to save costs in that sense. The other thing that are happening more and more in the underground mines, I'm not so sure about the open pits, are the ability to run underground scoops from almost anywhere. So if you could imagine somebody somebody sitting in their kitchen having their cup of tea and running the underground scoop, never being anywhere near the mine. I mean, we're not quite there yet, but we're getting there, and
clearly coming.
Like, you know, it certainly is.
That'll also appeal to millennials as well. I mean, in this conversation, we're not going on to staffing levels, but you know, I've been writing about that for yonks. We've got a real problem getting the youngsters to join the industry. Jeremy, can I bring you in? I'm sorry for the delay in bringing you in. North Shore advises clients on investment trends. Can you explain the significance of capital intensity in copper mining? And obviously by that I mean the ratio of capital investment to annual production.
Thanks, Chris. So capital intensity is how many US dollars I need to invest to get 1 unit of annual production expressed in US dollars per pound. So according to AME, capital intensity for copper projects coming on stream between 2015 and 23 is generally between 5 and 10 US dollars a pound, with a median value of $7.26. Now the large greenfield projects tend to be at the upper end. If you divide this median by the copper price of, say, 275, it means the intensity ratio represents about 2.6 years of copper revenue. Now, if you do the same exercise for gold at, say, US 1300, you get a value of about 1.7 years. So a sort of crude comparison, copper is more capital intensive across the whole range, about 50% or so more on average, and twice as intensive for these large greenfield projects. Now, the reason is that these large low-grade porphyry projects need to operate at huge scale to extract value from the low-value ore. And as the scale increases, the capital outlay actually increases disproportionately, especially if the project's remote. And that's to provide the supporting infrastructure, which includes roads, rail.
Can I just interrupt? Yeah, Jeremy, can I just interrupt? What happened to economies of scale? Just excuse ignorance, but doesn't it, as things get bigger, don't they normally get more efficient?
Well, they get it more efficient in terms of operating costs, but in terms of capital, as scale increases, the capital outlay itself increases disproportionately. And that's because of this additional infrastructure, which includes roads, rail, ports, power plants, and even new towns in the case of Las Bambas. So examples are, for example, Las Bambas costing 6.6 billion and Cobre Panama 6.3 billion. So what does this actually mean in terms of the industry? So the large new projects have to have, they will have a long build and a ramp up period, but they must have a long life to make a return. The amount of capital required means that the new porphyry projects can only realistically be developed by majors. The project expansions using existing infrastructure may be preferred as they tend to have a lower capital intensity, but the track record in terms of budgeting capital on these accurately in remote locations is not too good, as is attested by Oyu Tolgoi et al. Realistically also, if the juniors want to develop projects themselves, they need to target higher grade projects because higher value ore from the higher grade generally requires lower capacity and therefore lower capital intensity, and so less money in the first place, which is obviously has to be raised.
Yeah. Okay, that's excellent. Can we go to the first polling question? It's going to go up on the screen now, but it's the price of copper recently broke through $6,000 per ton. By the end of the year, compared with that benchmark, do you think the price will be up more than 10%, i.e. over 6,600, up more than 5%, i.e. 6,300 to 6,600, within 5% of the current level, i.e. that's plus minus $300, down more than 5%, i.e. down to 5,400 to 5,700, or down more than 10% by the end of the year, i.e. that's below 5,400. Perhaps the listeners could tell us what they think on that. Whilst we're waiting for that vote, can I ask the review of our experts? Keeble, I don't recall you saying, what was S&P Global's opinion of this year's copper price, i.e. what it's going to end the year at, and perhaps the average for the year?
Sure, so my forecast, which I've recently revised downwards again, is $2.71 dollars per pound, which is around, actually weirdly, around $6,000 per ton mark LME cash, and this kind of implies a price oscillation around 5,800 for the rest of the year, and I think I think that reflects kind of where investor sentiment is at the moment, in terms of, you know, when you saw the announcement of the 10% tariffs on the remaining $300 billion of trade between you know, Chinese exports to the US. We kind of tested where the next resistance level was, and it was about 650 for LME cash last week, so earlier this week. And we're back above that now that he's Donald Trump's gone back on that and said he's going to delay it to the end of the year. So I think that will help prices stay above 5,650. I think we're around 5,700 now. I see a little uptick towards the end of the year, but I don't think the fundamental reasons that the prices have dropped this year, apart from the trade war, such as the currency, the Chinese currency, how weak it's become, how unprofitable you know, Chinese imports of LME material. I don't think that's going to change this year. So I don't see much upside beyond 6,000 actually. Yeah. This year, that is.
Yeah, I apologise. I should, of course, put the in dollars per pound as well as dollars per tonne, shouldn't I? Your thoughts, Christopher? Do you agree with those comments from Keeble?
My feeling is that we'll see something like 280 broken through again this year. But I have pulled back what I expected for this year, and I expected to end the year over 3, and I don't think it's going to get there, mainly because you know, this trade war thing is quite intractable, much more intractable than it's looked. But then again, at the same time, we could all be surprised by Trump getting out of a different side of the bed tomorrow, as we've seen with the negotiations with North Korea, and suddenly, you know, peace and love is in the air. The Chinese, of course, you know, have got this saving face thing, and you know, they don't want to retreat. But when it comes down to it, the Chinese are suffering way more in this thing, I believe, than the US is. And so it's really up to the Chinese to sort of backtrack a bit. And I'm not sure how they do that, because it's essentially to abandon their growth concepts, and they're pulling everybody up from, you know, being a vast peasant mass into being a middle class. Is a big task, and it's not completed. And effectively, if they were to say, well, yeah, we're going to open up our economy, and we're not going to be predatory prices, and we're not going to try and dominate certain natural resource categories anymore, then that would be to say that the 300 or 400 million who are still in the peasant category are going to stay there, or they're only going to be, you know, very slowly moved out of that category. And they're you know, then you get a problem that in China at the moment, everybody's aspirational, but when you take away the aspirational possibility, then you start to get the social tensions. And you know, we're seeing social tensions on liberal democratic grounds in Hong Kong. Even worse would be if it was felt like a big chunk of the Chinese population was said, well, we've raised these ones up, but you're going to have to wait another 10, 20 years, you know, down on the pig farm before we move you up. And that is really one of the existential issues behind this whole trade war thing. So it's really up to Trump. So I would say, you know, something like 280 for the end of this year. But I'm still bullish. I think, you know, 320 by the end of next year, mainly because of the arguments that were stated before that, you know, there's great tightness out there. Old projects are running off. New projects are not being produced in big sizes. I see that in maybe 20 years from now, the projects you're going to be seeing developed are going to be a lot smaller than the ones we've seen in recent years, like Las Bambas. We're going to have the rise of the mammals to replace the dinosaurs of the.
I think that's right. Yeah.
As we're seeing in the nickel space, you know, in the nickel space, everyone who's out there is pretty much sure that we're not going to be seeing the type of things like in Ambatovi and Goro happening. The same thing is possible that Oyo Tolgoi and Las Bambas are going to be the last of a breed.
Yeah,
And mines are going to have to be more mid-sized and even small-sized.
Yeah,
The small-sized
agree,
mines still do exist in places like Chile. We
yeah.
don't hear about them, but there are quite a lot of them out there.
Well, in addition to the image of mammals and rather than dinosaurs, thanks for the image of Trump getting out of bed. Can we turn to the results of that first poll, just to see what? Oh, so yeah, that's pretty well split, up and down 5%, as you can see there. I mean, that's about as level as you can get. Beyond, there's not going to be a big move either way. We've taken quite a long time on that first section, so perhaps we can move on to the next one I've got scribbled down here, which is around issues around investing in copper. Jeremy, this is squarely in your area. How does North Shore advise investors to get its exposure to copper? And how does the structure of the industry at the moment affect the kind of investment exposure and the risk-return profiles available to your clients?
Wow. Exposure to copper means two things to me. So the first is to provide the investor with leverage to the copper price, and the second is to position the investor to capture upside from the discovery and development of copper assets. And they're kind of different things. So I'm going to comment on price in terms of financial instruments available and stocks of diversified mid-tier miners, and discovery in the context of the junior sector. Okay, in terms of price, the purest access is either via a copper ETF, or if you're a trader, via the futures market. So ETFs would enable investors to track futures prices or a basket of copper mining stocks passively and over time, whereas futures is generally a short-term leveraged instrument. Structurally, many of the world's largest copper mines are in the hands of the major diversified miners like BHP, Rio, Glencore, Anglo. However, copper is just a constituent part of their overall portfolio. So it's between 10 and 30% of EBITDA. So copper price will affect their share prices, but the other economic and commodity factors will matter more. The story is very different for the large and mid-tier pure play copper miners like Freeport-McMoRan and First Quantum, because these companies provide the greatest upside to price, because the price is leveraged through their various operations, and they're not purely dependent on the performance of one asset, just like a junior producer would be. So the mid-tiers are my choice for price exposure, with a couple of important factors to bear in mind when choosing one. First of all, the upside and the downside will be greater the higher the operating cost of the assets. So the case in point is Freeport's 2019 guidance, where a 3.6% price change will have a 17.5% impact on their operating cash flows. That's a leverage factor of nearly 5 times. The other thing that's going to matter in choosing a mid-tier is the ability to manage geographical risk, and that'll play a role in share performance. And if you look at First Quantum, for example, they've built Cobre Panama in part to reduce their 80% dependence on Zambia. Now, turning to the exploration development junior sectors arguments, structurally, the large amounts of capital required to build a large copper mine mean that the juniors are most likely to add value in exploration and feasibility. So if you're an investor, it's management quality, not the price, that is a key determinant of success to these companies. And the things to look out for, in my view, are a focus and knowledge of a specific jurisdiction and geological style, an early ability to articulate whether and how economic value can be created from the discovery, and a preparedness to walk away and move on if necessary, if it doesn't shape up. Thirdly, the ability to manage capital, avoid dilution, and form value-added partnerships to further the project but retain upside. Now, notwithstanding all of that, junior exploration is still low probability but highest reward. Investors should spread their risk accordingly.
Right. Yeah, that sounds like sound advice. I always thought I saved my colleagues a lot of money when I was editor at Mining Journal, because I didn't allow them to invest in mining shares because they were writing about them. But, a question for that's right. A question for Patrick, if I may. When Foran talks to investors, what are they actually looking for in a copper project? Obviously yours specifically, but generally, what do they ask?
Yeah, well, first I want to thank Jeremy and Chris for setting up this question for me. They couldn't have done a much better job. Really, our investors are looking, oddly enough, they're looking at the project. They've got to like the project, of course, and ours is a VMS deposit, which means as Chris was talking about. It's smaller, it's higher grade, it's less capital intensive to build, and it has a variety of metals besides the copper. It's got some zinc and gold as both of those as we see as being good metals to have in the mix. So, but another thing they really do focus on, it's like real estate, is location, location, location. There's no use building something in a location where the government's going to steal it 5 years after you have it operating. So they like the fact we're in Saskatchewan, that the laws are very clear in mining, that mines are built there. So they look for mining jurisdictions that are friendly, and you know, they look for governments that are stable. So political risk has to be lower. In our case, we also are big shareholders. Our management are big shareholders in our own company, so they like the fact that groups like ours are invested beside them, and because of that, we've attracted a stellar group of investors. Guys like Pierre Lassonde, the chairman of Franco-Nevada, is a 10% holder. So again, other investors do like that. They like to know that you're putting your money in beside them, and that there's guys like Pierre, who is a bit of a legend in the industry, that that he's there too. So all of that with an experienced board and management, things that Jeremy was talking about, also helps them feel more confident. So I think there are not that many projects in the world that really tick off all those boxes. So it kind of funnels people towards our company and project, and that's what they like.
Yeah, I concur. I mean, I used to, when I was at Mining Journal, I used to interview a lot of fund managers, and in fact, I did a survey of 100, and overwhelmingly the thing they looked for most was the people. In fact, there was a few that did it to the exclusion of the projects. You know, if they were happy with the people, they'd just invest on the people. Keeble, do you have a view on investor appetite at the moment for copper, and what's driving, what sort of things they look for?
Yeah, so I think investor appetite is still fairly strong, despite the volatility in copper cathode prices. We've seen some significant investments in copper projects, both brownfields and greenfields, notably Anglo American, Quellaveco, Tex, QB Sulfides, and Ivanhoe's Kamoa-Kakula. I think investors remain buoyant because of some of the mitigating factors that I mentioned before, that are partly offsetting volatility in copper prices, which may go on for who knows how long. Some of this is to do with the fact that there's declining ore grades. Some of this is to do with the fact that discoveries have been way lower at the moment than they have been in history, and also the fact that byproducts exist within a lot of these deposits. You don't ever get copper on its own. You get largely gold, molybdenum, and cobalt. So a lot of these, especially gold at the moment, is doing really well, and so that's going to be improving the economics of some of these projects. Right. And also, cobalt is a strategic mineral, right? So
yeah. Can I just interrupt? Am I right in saying that the American copper mines don't have much in the way of byproducts, or am I remembering it wrongly?
Yeah, I haven't heard of too much byproducts, but it's actually gold. Yeah.
Gold.
Yeah.
Right. Okay. Christopher, can I touch on geopolitical factors while we're on this subject? How relevant are they to investment decisions? I'm thinking in particular, as we just heard, sort of copper occurring with cobalt, for example, in the DRC. And does Housekeeping have a factor in political risk when giving it investment advice?
Absolutely. Because some people at the moment, as was just pointed out, remain bullish on copper despite whatever the short-term things going on are, where the price is. But some of these jurisdictions have just made themselves so unattractive and repeatedly that they're ruling themselves out of contention. The DRC may still be acceptable for some mining companies that are already there, but for many investors, they just won't go near it with a barge pole. And that's not really it's not good, but it is good that the investors are discriminating. because you know, Tanzania is a good example. I mean, it's not really a copper destination, but you know, it's in everybody's penalty box at the moment. You just can't do anything with the project there. Because investors just don't want to play. And it has to sink into the country's leadership that you can't do the type of things that have been done and still expect investors to keep coming back. And so there is definitely a blacklist out there of countries that you just don't want to go to.
I think that's going to take a while. I mean, my son works for First Quantum, and he's having a trouble getting a visa going out to Zambia. So
yeah, Zambia's been a relatively good-looking place, and even within the last 10 years. And now it's
until recently
out of darkness.
That's right. Yeah. Can we move to our second poll? The red metal is often described as Dr. Copper because it has historically predicted global economic trends. This is to people that answered the first poll in question. Was your answer to the first poll because you think the price of copper this year will outperform the global economy, will broadly track the global economy, will underperform the global economy, or the price of copper is now uncoupled from the performance of the global economy? While we're waiting for those votes to come in, Keeble, could I ask you which copper exploration projects currently excite you and or S&P Global?
Yeah, interesting question. I'd like to highlight to listeners that I'm not in the business of giving investment advice, so none of my analysis should be like construed. I would get a lot of trouble with compliance.
And presumably Standard & Poor's doesn't rate accordingly.
Yes. Well, yeah. I mean, I was briefed heavily by compliance before answering this question.
Right. Yes, I know you were. That's why I asked you it.
But in general, I think I would say there are projects that tend to make it. The projects that tend to make it into the project pipeline, you know, under the committed or highly probable categories, are the ones with strong technical prospects and you know, existing involvement, rising involvement by a major, and also you know, low country risk factors, which I think have really come to the fore this year. I'd agree with other panelists, so that's exactly what's become, you know, very important when you look at a project. I think Cobra Panama is the only 100,000 ton per year project starting up this year, and I'd also add Anglo American's Quellaveco is probably the largest project in my pipeline at the moment, over 300,000 tons per year of average annual production. I think that's starting in 2022 at the moment. It is in Peru, which, you know, as you guys have probably been seeing in the news, you know, with the Tia Maria, Southern Copper's the revocation of their license to develop that project, Tia Maria in Peru. You know, whether that, I'd leave it up to the audience whether that's a litmus test, you know, for other projects, because I think Peru is going to be a key destination. And there's a lot of projects there. Southern Copper's got another big project there called Michikia, which is quite deep in the pipeline, but it's definitely something they're serious about. The other one I would definitely mention before passing on would be Kamoa-Kakula, because it does have a very high grade. When I do my comparisons between all the projects, the greenfield projects, when I compare grade and head grade and capital intensity, Kamoa-Kakula always ends up being very low capital intensity and very high grade. It just stands out, you know. So that's a project that's very likely to enter the pipeline in the next few years. Yeah.
Okay. For those who are not aware, incidentally, on the line, Keeble does a monthly copper briefing report, which I'm sure he'd let you see if you asked. Can we see the results of that query, a poll? Oh, right. Well, that's pretty conclusive that the listeners reckon that whatever they answered on the first one, good or bad, they think it's because it's tracking the global economy. We've almost used up our 45 minutes, but we're allowed to go slightly over. So if we can press on to the third and final section, which is let's discuss some of the issues around copper production itself. Patrick, as a sort of somebody at the sharp end of the industry, you know, Foran is active in Saskatchewan in particular, but if you look globally, what do you think are the most significant costs in producing copper? We alluded to it earlier, mainly labour, and how will this distinguish successful from unsuccessful operations in the future?
Well, actually, I think the various panelists touched on it beautifully, and I just be repeating what they've said, which is really the size of the deposit, the grade, the location. These are fairly key if you're going to have a chance for success in getting a project going. So you know, I think
skilled workforce fits in with the location, does it? So I mean,
yeah, absolutely. And you know, we're fortunate in our project that we are right beside a mining town. So having a skilled labor force, also that being in a mining jurisdiction, also we're not in a completely greenfield area, so you tend to have less opposition to building a mine where there are already mines that are available. So political considerations are a huge part of that, and I believe Jeremy was talking about you know, the fact that large open pits require large capital expense to build. And of course, you were talking about you know, scale, and that's true. They've got lower operating costs because of that. But the risk up front for your investors in a capital project like that is huge before they ever see a return. So you know, they could lose $1 billion, $1.5 billion in a heartbeat's hardly a way to put it, but over a couple of years, especially if metal prices turn against you just as you're about to start operating. And one of the things our industry unfortunately faces is we don't prepare to open up copper mines in these climates where copper prices are low because it's hard to raise the capital. We wait till copper prices are high, and then money floods in, and we manage to open them just in time to catch the peak, and then we ride the wave down, which is disastrous for a lot of these mines. So you know, that's unfortunate the way we are. We're always chasing the tail end, but that's a reality in our industry. So
yeah, that's true of all the different metals, isn't it? Yeah. Can I ask a joint question for Jeremy and Christopher? From the viewpoint of investors, what technology changes do you think may impact the production of copper? We've been saying that, you know, the mining industry generally hasn't changed much in 40 years. But do you see anything coming up on the radar that's going to change things? Perhaps Jeremy first.
So the dominant investor issues are going to be profit and the environment. So technology is going to address profit through trying to improve recoveries and higher productivity, and the environment through better water recycling and waste management, and both of the above through resource usage of energy and materials. I think what we're going to see is we're going to see known technologies optimized to provide incremental benefits to the conventional mining and processing setup for sulfide and oxide ore, and then transformational technology developed over time to change the process itself. Now, I'm not going to go into the specifics of the individual optimization issues, but in terms of transformational technology, if it comes, I think it's likely to come in the area of processing, and specifically things like the efficient leaching of sulfide ore, particularly chalcopyrite, as well as oxides, which are already leached, and in that, the capture of other valuable metals in the process, because that'll remove transportation and smelting and could lead to one overall sort of beneficiation activity. The other thing that could happen transformationally in the future is if leach chemistry can be found which is effective and environmentally friendly, we might eventually see in situ leaching, which would have a much reduced mine footprint. And obviously that ticks boxes from a cost, capital, and environmental point of view. And possibilities there exist around things like alkaline glycine leach, which is already been tested here in Australia.
Right. Okay, Christopher, have you got any thoughts to add to
that? Back to a point that was made before about automation in the mines. One of the areas, though, that we've seen the biggest bloat has not actually been in the cost of running the mine when it's operational. It's in the capex, and I'm not seeing technology helping with the capex at all. If anything, the use of some of these technologies is sort of like front-end loading the technology cost into the capex, just making it bigger. Yeah. I also have extremely cynical about artificial intelligence. where many people are saying, oh, we could use artificial intelligence in the mining. I think we need more artificial intelligence in the boardroom and less at the mine site.
Right.
Perhaps as president of the United
many
States.
Of the boardrooms is not all that clear. Yeah, I think that there's limits to how far you can go, and certainly many of these, Uber technologies that people are talking about might work with really mega big mines. But as I said before, I'm looking forward to smaller mines and really turning a truck from drivered to non-drivered in the Peruvian mountains. Are you saving all that much money? I'm not sure about that.
Yeah, no, I agree. Okay, let's move to our third and final poll. Apart from the performance of the global economy generally, which we touched on the second poll, what do you think will be the most important determinant of the copper price over the next 5 years? Is it electric vehicles and the demand for batteries, which we mentioned, urbanization, which we haven't mentioned, and the increased consumption of white goods? Obviously, the world's population is now 50% urbanized and still increasing. Declining ore grades in copper deposits, or difficulties in delivering the mined metal, for example, strikes and planning restrictions, etc. Whilst we're waiting for the listeners to ponder that, Keeble, where are the next major copper discoveries likely to come? You talked about some of the individual ones you were looking at, but are there other geographies of the world that are key at the moment? And what role is being played between the majors and juniors, which is the big issue? When I started in the industry, it was all majors doing the exploration, and that changed entirely. So that it was largely the juniors, particularly obviously in gold. But do you see how do you see the trend going forwards?
Yeah, it's an interesting question. We've got a team, as you know, in Halifax that compiles this data every year, corporate exploration strategies, and they sort of speak to, for the most recent report, they spoke to 1,651 companies to get their exploration budgets, and they've produced a report which I've just recently read to see what the trends are, and it looks like you're right. Juniors are playing a bigger role, but they seem to be more widely diversified. Their exploration budgets are much more widely diversified in terms of the base metals, whereas majors have become increasingly interested in copper. I think the stat that we got was 3/4 of majors' exploration budgets in base metals was just on copper, right? So, overwhelming majority of the interest for exploration budgets among majors is for copper, where it's more, just to reiterate, it's more diversified. So the juniors might be exploring more, but a high proportion is going to copper for majors than to juniors. In terms of location, it's an interesting one. Africa has seen a big increase in budgets, but that's primarily because of the DRC, and that's, as you know, all to do with the copper cobalt down there. And interestingly, the United States is also now a key destination for copper. Copper and gold exploration budgets have actually been holding up the US's quite a high place in terms of the country level exploration budgets. So yeah, I'm sure everyone's heard about Rio Tinto's, I'm not sure how you pronounce it, but is it Winu in Western Australia, and BHP's yet unnamed discovery near Olympic Dam in South Australia, which are probably the most recent discoveries in copper, I'd say.
Right.
Major discoveries.
Okay, thanks. Can we have the results of the final poll? Well, that's fairly well split, but interesting. The one question I hadn't actually raised particularly was the listeners think urbanization is the key other factor apart from the global economy. Clearly, there's a lot more white goods, and China is disappearing into the conurbations, and will clearly need more copper. that's more or less all we've got time for. Perhaps I can quickly go to all four of our panelists and ask for a one-word answer, if I may. Are you bullish, bearish, or undecided over the prospects for the copper price over the next 12 months? Jeremy, bull, bear, or don't know?
Undecided.
Undecided, yeah. Keeble?
Undecided.
This is going to be riveting, isn't it? Christopher?
Whoa.
Oh, good stuff. Patrick, 1-1 draw or 2-0?
Absolutely a bull.
Oh, good stuff. I should have guessed that, actually. Yeah, 2-0. That's excellent. That's it. That's all we've got time for, I'm afraid. It remains for me to thank everyone for listening, and particular thanks, of course, to our 4 panelists. And sorry that our 5th panelist couldn't join us, but Christopher, Jeremy, Keeble, and Patrick, thanks for your excellent insight. We'll all be covering copper in great detail at the upcoming Mines and Money events, November the 25th, 27th. And all listeners to this broadcast and those that catch it on the recorded version entitled to a discount by using the following code, MMLWebb. Case doesn't matter. For more news and content, please check out the dedicated website at www.miningbeacon.com. Many thanks, and see you all again soon. Thank you.
Thanks.